Is there anything more that can be done to entice investors as we move into the upcoming year? It's fantastic to see you, Tom Lee of Fundstrat, who joins me at Post 9 and contributes to CNBC. It's great to see you, so let's add up all the good things. I mean, I know you've been kind of in gear with that idea that the economy would power through inflation would come down, the AI could become friendlier, earnings are going higher. Big question to me is, how do we set expectations for the year to come given that that's all in the books? It's a great question, because we have two back-to-back 20% years, and now investors are wondering how much good news is baked in. But if we look at the 2025 environment, it's a great setup, because we have a new administration coming in that's maybe pro-animal spirits. A Trump put, we have a Deutsche Fed, and as you're pointing out, interest rates are kind of calming down after rising, and we know there's still $7 trillion cash on the sidelines, and I think sentiment's coming back into check. You mentioned that before with the AI num, so I think it's a good setup for investors. I wouldn't be too worried about the next 12 months, so don't be too worried. I mean, it seems as if there are all these supportive factors. And when you mentioned the 220% up years in a row, history says actually the following year is up more often than not as well. What you mean? Do you think specifically by the new administration being pro-animal spirits? First of all, it's true, you kind of seen it at work, it seems to pull in that direction. But are there specifics that the market is fixated on that it's going to drive that dynamic? Yes, I think that the market's trying to figure out exactly how this animal spirits plays out in markets. But I would say we've got a Treasury Secretary that equity markets approve of. We do know that the last Trump presidency was cared very much about what stock prices do, and Jeremy Siegel said this is the most stock market-focused president ever. And I think that the uncertainty is around trade and the potential risk around tariffs, but we'll have to see. I mean, that's something markets are going to have to deal with it from an uncertainty perspective. It's interesting to me that the way the market has behaved in the last several weeks. But even going into the election was, we need to owe more cycle, we need to owe more financial stocks. We're going to repick this market for a maybe of growth acceleration, even or at least a maintaining above trend growth. Meanwhile, though we're only a couple months removed from a pretty big growth scare, job growth has kind of slowed to a point. The housing market seems pretty locked up. It's kind of interesting how the sentiment has kind of jumped ahead. Is the economic numbers position to actually validate that view? Markets tend to be forward-looking, so I would expect this. I know there has been a recession in durable goods and in housing and auto sales, principally because of high rates, which have made it affordability an issue that's really on the come next year. I mean, I think the spread of 10 years in mortgages should come down and the 10-year hopefully behaves. And I think if there's more confidence and more supply, I think housing actually could lead this recovery. I think that's why home builders actually started to act better this week as well. Yes, they seem very sensitive to the yields, sort of halting their rise as well. I guess the question is if we believe it's still a supportive environment, and pretty much all the things you can identify, I would suggest you shouldn't be too worried about next year. The second question is something like the S&P 500 the best vehicle to capitalize on that? I think investors are still trying to figure this out. We did a survey with our institutional investors and our raw clients last week. The majority of institutional investors don't think FANG is the leading trade. They're actually betting on cyclicals. But if you look at the raw world, the majority are betting on FANG. So I think the market is still undecided whether to be long the Mag 7 or the cyclicals. I'm inclined to be more cyclical and better even on small caps, having an extremely busy year next year. So let's welcome Ed Yardeni this morning to discuss the markets in more detail. Of course, Yardeni is the president of research. Happy Black Friday, Ed. Great to have you. Thank you. You've been writing a lot obviously lately about the coming year, and actually the next few years. I know where we've talked a lot about your 7K target, your 10K target down the road. To Sarah's point about the market broadening, is that I guess healthy on a net basis? Absolutely. You remember when this bull market got started, it was kind of like the Rodney Dangerfield bull markets. It got no respect because it was so narrow, and we argued that give it some time it'll broaden, and that's what it's doing now. And we've certainly seen the midcaps go on fire, and then the S&P 493 I think are going to do well, increasingly well. What do you think's going on with these yields? Are our bond vigilants convinced that there will be constructive work done in this administration? Yeah, absolutely. I think the Trump administration, incoming administration, about some time I kind of played it to the bond vigilance by basically acknowledging that we've got a problem with the deficit. And the new incoming Treasury Secretary is somebody who's gotten a lot of market experience, so he's kind of like one of us, if you will, when the market looks at this administration. And the fact that they're in fact going to go after a spending H, and that they're going to try to raise some revenues, maybe with an across-the-board tariffs at least, shows that they're cognizant of the problem, and maybe they're kind of having a Bill Clinton moment. Remember when Bill Clinton was warned by his advisors, don't mess with the bond vigilance. And we actually had a very conservative fiscal policy back then. Well, I mean, analogies to the mid-90s are pretty positive. And there has been some work done looking at what happens when you bring the budget deficit relative to GDP lower. Kind of it's an everything rally. Is it not? It becomes an everything rally. And you know the only risk is that it becomes too much of a good thing, that it becomes a melt up. And we're kind of on the edge there, right? We've got the valuation multiples which are quite elevated, we've got the forward PE around 22, we've got the buffet ratio around 2.8, which is a record high, we've got Warren Buffett himself raising a lot of cash, which kind of has everybody somewhat concerned. But all in all, I think the bull market is still very much here and continues into the next year. And I don't see a recession. Recessions are usually caused by credit crunches. And that's not happening with the FEE inclined to lower interest rates. It's not happening with the price of oil, unable to have a rally with geopolitical risks, which seem to be actually narrowing. So the only thing left to worry about, I think, is tariffs. And right now, it looks like they are being effectively used for negotiating purposes. I mean, there's been so many flows into U.S. equities. Because of all these reasons we're talking about, EFA reported $141 billion into U.S. equities. And that's for the month, the heaviest inflows in a 4-week period on record. So do you want to just continue that trend, or do you want to go somewhere contrarian like Europe, where everybody hates right now? Well, you're asking the wrong person. Since 2010, I've advocated staying at home rather than going global. The US has been on fire lately, but you're right, from a contrarian standpoint, it might be worthwhile to look overseas for a little while. But no, I'm going to continue to stay at home and invest. By the way, I don't like what you just said, because it's talking about contrary indicators when it comes to